The stunning resilience and health of the U.S. economy confirmed in a macroeconomic data yesterday and propelled a rally in the U.S. dollar and Treasury yields. In contrast, the stock market sentiment turned sour. The benchmark stock indexes were hit by a sell-off. Investors began revising their portfolios, bets on interest rates and inflation expectations. The odds are that the stock market will go deeper into seller's territory. The New York pre-market is following the trends of yesterday. Investors are anticipating remarks by several Fed's policymakers who could make their impact on a market sentiment. For a start, let's sum up the results of Wednesday. The Dow Jones lost 198 points or 0.57%. The Nasdaq slipped by 148 points or 1.06%. The SP 500 shed 0.7% to close at 4,465 points. The market did not regain optimism in the New York pre-market. The benchmark stock indexes went down into the red zone. Futures on the stock indexes fell by 0.26 and 1.23%. The S&P 500 is expected to trade in the intraday corridor between 4,390 and 4,470 points. The three major indexes closed lower yesterday after a stronger-than-expected services PMI raised concern that inflation would remain stubborn and interest rates would be kept at elevated levels. The Institute for Supply Management reported yesterday that its services PMI grew to 54.5 in August, much stronger than the 52.5 projected. The data shows that the battle with inflation is not won yet, so the Federal Reserve could resort to another rate hike in November, whereas the market bets on the Fed's pause in rate hikes in September remains above 90%. The market suggests a 50-50 chance for a rate hike and a pause in November. Obviously, the latest statistics push market expectations for rate cuts further into the background, prompting traders to reassess risks. Earlier on Wednesday, Boston Fed President Susan Collins emphasized that the central bank needs to act cautiously in its next policy moves. The prospect of higher rates particularly waned on growth stocks. The S&P 500 growth index lagged behind the benchmark during the session. Stock investors also responded to the rise in yields of 10-year and 2-year treasuries. Out of the 11 primary sectors of the S&P 500, the steepest decline was seen in the tech sector, at 1.4%, while stocks in the energy sector were the only ones to gain 0.1%, bolstered by high oil prices. Stock index futures continued their decline on a Thursday, following weaker-than-expected jobless claim data for the previous week, highlighting concerns that interest rates might remain elevated for longer than anticipated. The U.S. Labor Department reported that initial jobless claims increased by 216,000 last week versus 234,000 claims in the consensus. The number of initial applications grew by 229,000 in the previous week. Apart from jobless claims, the market was disappointed by a separate report on the labor unit cost for the second quarter. The indicator sank to 2.2% from a 4.2%, though it surpassed the 1.6% expected. The recent data fit into the overall picture painted by this week's macro statistics. The data indicates that the fight against inflation might drag on and the Fed might keep interest rates high for long. The Fed's Budget Book on Economic Conditions published on Wednesday appeared relatively calm. The report showed modest economic growth in the United States over recent weeks, While job growth was moderate and inflation slowed in most parts of the country, the market's reaction to the data was muted. Now, Wall Street's attention is once again shifting to what Fed policymakers think about the acceleration of economic growth in the United States, the recovery of energy prices, and some mixed signals from the tense labor market. There will be a lot of food for thought today. At least 6 senior Fed officials are due to speak later on Thursday, including Federal Reserve Board member Michelle Bowman and Fed Presidents John Williams, Austin Cosby, Patrick Harker, Raphael Bostic, and Lori Logan. As for other catalysts of the day, the yield on the long-term treasuries fluctuated at a 2-week high of almost 4.28% and approached the highs of the previous months. Apple shares dropped by another 2.5% in the pre-market trading on reports that China is looking to extend its iPhone ban to state-owned firms and agencies. The US dollar is the main beneficiary of all worries about a global economic slowdown and the hawkish Fed. The greenback extended its rally today. Its index is trading at 105.03 at the time of recording this video, 0.17% up. The intraday Canada is defined between 104.70 and 105.40. The US dollar is again in bullish momentum because the market expresses doubts whether the Fed has completed its monetary tightening. At the same time, other major central banks are hesitant or softening their rhetoric. As the robust growth of the U.S. service sector in the August accelerated, the striking difference between economic conditions in the United States, Europe, and China began to widen once again. The dollar index against the most traded currencies has been rising for 6 consecutive days. The index has jumped by nearly 5.5% since mid-July, as the governor of the Bank of England, Andrew Bailey, stated on Wednesday that the rate hikes in the UK are nearly done, and the pound sterling bore the brunt over the last 24 hours and tumbled to a 3-month low against the dollar. Fresh data on Thursday helped the index maintain its dominance. Investors are anticipating a lot of Fed speakers who may catch investors off guard. However, the medium-term outlook for the dollar remains on a top. The Canadian dollar is losing ground against its strong American counterpart. The USD CAD pay is now trading at 1.3650, 0.12% up. The intraday Canada for the instrument is defined between 1.3600 and 1.3680. The loonie is hovering at about 5 months lows against the US dollar. The Bank of Canada raised the overnight target rate at 5% as expected. The decision was made because the economy entered a period of weak growth. Given recent data indicating that excess demand in the economy is diminishing and taking into account the lagging effects of monetary policy, the Board of Governors has decided to maintain the interest rate at 5%. The bank's statement reads, "The bank noted that it's prepared to raise interest rates higher if inflationary pressure persists, but analysts commented that a hawkish stance is unlikely to signify further rate hikes, at least not in the near future." Against this backdrop, the loonie reached a 5-month low of 1.3676 but later retreated. The Canadian dollar is awaiting more clarity regarding future policy today and potentially new impulses. Bank of Canada Governor Tiff Macklem will deliver a speech and hold a press conference later today. Meanwhile, the crypto market is trading sideways with minor fluctuations today. Bitcoin is hovering at around $25,700, 0.13% up. Crypto assets have not emerged from a hibernation yet, but it could happen anytime soon. The reason is the same regulation. This time, It's not about the US Securities and Exchange Commission, but G20 and the IMF. At the summit, the G20 countries are due to present a roadmap to concord measures among the nations. Such measures should not undermine macroeconomic and financial stability, and the document criticizes cryptocurrency assets and the risks of unregulated market development, outlining the timeline for IMF members and the G20 to implement the latest recommendations from the Financial Stability Board on a cryptocurrency regulation. The document will be presented at the summit in New Delhi later this month, and the market had no immediate reaction to the news, possibly not having had the time to assess the regulators' ideas yet. Bitcoin continued to hover around 25,700 without changes. The forecast remains the same. If the price does not hold, it could drop to the 25,400 and 25,000 range. An alternative scenario would see recovery above $26,000. Make profits with the InstaForex. Feel free to leave your feedback and ask any questions. Let's make our TV channel better together. See you online tomorrow.